Let's look at cost behavior and how we can classify costs based on that behavior. So cost behavior is the study of how specific costs respond to changes in the level of business activity. Well, what is business activity? Well, it's really the thing that causes the cost to change, or the easier way to think about it is what drives the revenues for that company. For example, what causes revenues to increase at a coffee shop? Well, the number of coffees they sell. What causes expenses then to increase at a coffee shop? The number of coffees they sell. Because the more coffees they sell, the more materials they're going to need, the more labor, and maybe more overhead costs as well. But as our revenues increase from selling coffees, not all costs will change. Some of our costs are fixed, some are variable, and some are mixed. And so we're going to look at those different costs. Let's start with fixed costs. Fixed costs are costs a company incurs where the unit cost is inversely related to the activity, but the total cost does not change. Fixed costs are often per month costs. So an example would be rent for the building for our coffee shop. Our rent cost is $1,000 per month. Our total cost is constant. However, our unit cost, our cost per cup of coffee sold, because coffees sold is our activity, our unit cost decreases as our activity level increases. Sometimes it's easier to look at this as a graph. Here we can see our graph of our rent cost. When we look at our rent, our total cost is constant. It's a straight line here. It doesn't change as our activity level increases. But our unit cost is decreasing as our activity level increases. Next, let's look at some common fixed costs. Fixed costs you might see could be rent, insurance, salaries for employees that are paid the same every month, straight line depreciation, property tax, and again, most per month costs are going to be fixed costs. Next, let's look at variable costs. Variable cost is where the unit cost does not change with the activity, but the total cost varies proportionally with changes in activity. And by very proportionally, I mean it changes at the same rate as the activity level. An example for our coffee shop might be the disposable cups. It might cost the company 10 cents for each disposable cup. So the unit cost is constant, but the total cost increases as we sell more cups of coffee. So again, if we look at our graph here, we can see our unit cost is a constant straight line. It does not change. However, our total cost is changing at the same rate as our activity. It's a constant increase as we increase our number of coffees sold. Some common variable costs are your direct materials, because those go into every item you produce. Your direct labor, same thing. Some of your indirect costs could be variable. And also, if we have a per unit shipping cost where we're shipping products out to customers, that could also be a variable cost. Now, before we move on, let's compare our fixed versus variable costs. So our variable cost, the unit cost does not change, but in a fixed cost, the unit cost changes inversely with changes in activity, meaning they're opposites. Activity goes up, unit cost goes down. Now, for variable cost, the total cost is the one that varies, and it varies proportionally, meaning they change at the same rate. If my variable activity doubles, my cost doubles. However, on a fixed cost, that cost does not change in total. So our constants are different. For our variable cost, our constant is the unit. That one doesn't change. For our fixed cost, our constant is the total cost. And then the other ones are the ones that change, that are not constants. Lastly, let's look at mixed cost. So mixed costs are called mixed because they consist of a cost that is part variable, part fixed, which means the unit cost changes with the activity. The total cost also changes with activity, but not necessarily proportionally like a variable cost would. An example here could be our utilities costs for our coffee shop. Again, our activity level is the number of cups of coffee we sell, we can see our total cost of utilities increases as we sell more coffees, but the unit cost is not a constant change. And again, if we graph it, it makes it easier to see. We can see on our graph here that our total cost changes, but it's not a straight line. It's not direct and proportional. And same with our unit cost. That one's changing as well. Because again, this mixed cost has some component of a fixed element to it and also a component of a variable element to it. The most common mixed costs you're going to see, especially in a classroom environment, are going to be utilities costs like electricity, water, and maintenance costs, right? Because if you think of a car, there's a base amount of maintenance you need, but then also the more you use it, the more maintenance costs you'll have. Okay. Now, before I finish, I just want to make a quick note about the relevant range. So the relevant range is the range of activity levels that can be produced at a company. And within this relevant range, that's where we find these cost relationships to be true, where variable costs are variable, fixed costs are fixed. Okay. Typically, it's like 1 year's worth of operations is a typical relevant range. Okay. If we go outside this relevant range, we start expanding and we open a second coffee shop, right? Then our cost behavior can change or can be harder to predict. So when we're looking at our analysis, we're staying within our relevant range to make our cost behavior predictable. All right, I hope that helps you understand the different types of costs. If you would like to learn more about mixed costs, be sure to check out my video on the high-low method for estimating the fixed and variable component of those mixed costs.